Most people believe markets move when news breaks. That's comforting. It suggests fairness. It suggests that everyone sees the same information at the same time and reacts together. But that belief is wrong, dangerously wrong, because by the time the headline hits your screen, the real decision has already been made. The capital has already moved. The position has already been built. And the price you're reacting to is the after effect, not the cause. Let me ask you something. Have you ever wondered how a stock can rise quietly for weeks, almost unnoticed, and then suddenly the world discovers that a massive institutional player is already deeply invested? No volatility, no obvious buying pressure, no warning signs. And yet, when the disclosure appears, the position is enormous, fully formed, surgical. That doesn't happen by accident. It happens because the modern market is not a stage. It's a machine. And those who understand the machine don't chase attention. They avoid it. While most investors are watching charts, someone else is watching liquidity. While the crowd is waiting for confirmation, someone else is already executing. Slowly, methodically, invisibly, share by share, venue by venue, day after day, no headlines, no hype, just precision. Here's the uncomfortable truth. The market you see is not the market that matters. Behind the screens you stare at, there is a second layer: private venues, hidden liquidity, algorithmic execution, derivative exposure, delayed disclosures. A layer designed not for speed, but for control. And it's within that layer that the largest positions in the world are quietly constructed. This is where perception and reality split apart. You see volume, they see opportunity. You see price, they see cost. You see disclosure, they see the end of a process. And the reason most people never catch this early isn't because they're unintelligent. It's because they're looking in the wrong place. They're waiting to be told what already happened instead of understanding how it happens. Today, we're going to pull back that curtain. We're going to walk through how a massive stock position can be built without triggering alarms, without pushing the price, without alerting competitors, and without the market realizing what's happening until it's already too late to copy. If you've ever wondered why institutions seem to arrive early while everyone else arrives loud, stay with me. Because once you understand this, you'll never look at price, volume, or headlines the same way again. This is not about tricks. This is not about shortcuts. This is about how power actually moves in modern markets. And once you see it, you can't unsee it. When a market participant decides they want a meaningful stake in a company, they don't wander onto a lit exchange and dump a giant order in front of every algobot, high-frequency trader, and retail screen out there. That's how you move the price against yourself. You trade the infrastructure of the market itself. The plumbing, not the public quote. The first thing to understand is that most of the market's visible tape is a partial view of where the real liquidity lies. Public exchanges show bids and offers, but they don't show large blocks of stock that are willing to change hands at agreed prices off that public book. That's where off-exchange trading venues, colloquially called dark pools, enter the picture. A dark pool is a private or alternative trading system where large orders are matched without prior public exposure. Unlike the NYSE or NASDAQ, orders in a dark pool aren't displayed on the public order book before execution. This matters because if you broadcast a giant buy order on a public venue, every sophisticated trader with speed and capital will react. They'll start stepping in front of you, pushing the price up, raising your cost of acquisition, and turning your quiet accumulation into a headline price surge. Dark liquidity lets you execute block trades, sometimes tens or hundreds of thousands of shares at a time, with minimal market impact precisely because there's no pre-trade transparency. To the rest of the market, it looks like nothing happened until the prints come through on the consolidated tape after execution. Institutions lean on these dark venues for a reason. Anonymity preserves the integrity of a trading thesis. There's no signaling, no parade of algos sniffing out your intent, no retail crowding in ahead of you. You negotiate discreetly via broker, dealer networks, or programmatic routing into multiple dark pools so that no single visible footprint gives away the scale of your intent. But dark pools aren't the whole story. When you slice a large position into many smaller orders and distribute them over time and across venues, some public, some private, you reduce your footprint even further. Algorithms are often employed that target volume weighted average price VWPM or time weighted average price TDB benchmarks. These break a gigantic desired quantity into thousands of micro orders executed at opportunistic moments when liquidity is naturally abundant. That way, you're not the cause of a price imbalance, you're working with it. At the end of the day, the most effective accumulation strategy is the one the market never notices until it's already happened. It relies on venues where trade details don't show up until after execution, fragmentation of order flow, and a deep understanding of how visible and hidden liquidity interact. Successful players stay several moves ahead, extracting shares quietly, minimizing slippage, and preserving the very price discovery mechanisms that signal a breakout to everyone else. That's how you build substantial positions without creating unnecessary volatility or alerting competitors to your agenda. When people think they're tracking institutional conviction, they usually point to public filings and believe they're seeing the present. In reality, they're studying history, carefully curated, incomplete, and deliberately late. The disclosure system was never designed to give real-time transparency into how large capital actually moves. It was designed to balance oversight with the protection of intellectual property. And for anyone who understands that balance, it becomes an advantage. Consider how public reporting really works. Large investment managers are required to disclose certain holdings only once a quarter, and even then with a delay that can stretch well beyond a month after the quarter ends. By the time a filing becomes public, the positions it reflects may have been accumulated months earlier, adjusted materially, hedged, or even exited in part. What the public interprets as a new buy is often the final chapter of a trade, not the opening act. More importantly, these filings capture only a subset of exposure. They focus on long positions in U.S. listed equities and certain instruments. They do not reveal intraday activity. They do not show short positions. They do not reflect many derivatives, swaps, or synthetic structures that may represent substantial economic exposure. In other words, they show ownership, not intent, and certainly not risk positioning. Anyone treating them as a live feed is already behind. This delay is not a loophole. It's a recognition of reality. If every large manager were forced to disclose positions immediately, markets would become less efficient, not more. Copycat behavior would distort prices, front-running would flourish, and original research would be penalized rather than rewarded. The disclosure framework protects the incentive to do deep, independent work. Those who build that work understand how to operate within it. Sophisticated capital allocators know this, and they plan accordingly. Positions are often built quietly over long periods, with disclosure treated as an afterthought rather than a signal. By the time the market reacts to a filing, the real opportunity has already been priced in. Retail observers rush in on confirmation while institutions are already managing exposure, trimming risk, or rotating into the next idea. This creates a recurring illusion. Headlines announce a large stake, commentators debate the thesis, and prices move, all while the original buyer is no longer acting. The filing becomes a marketing event for the market, not a trading opportunity for the filer. Those who understand timing never confuse transparency with immediacy. The deeper lesson is discipline. Real conviction doesn't require public validation. It requires patience, execution, and the willingness to let the market discover your view on its own schedule. Filings are compliance documents, not invitations. They reward those who read them in context and punish those who chase them blindly. In modern markets, information asymmetry isn't about secrecy. It's about time. The difference between leading and following is measured in quarters, not headlines. And the investors who consistently win are the ones who treat public disclosure as confirmation of past work, never as a roadmap for future returns. Most people equate influence with ownership. They look for names on shareholder registers and assume that's where power begins and ends. That assumption is outdated. In modern markets, exposure matters more than certificates, and economic reality often diverges sharply from what appears on paper. There are sophisticated ways to gain meaningful exposure to a company without ever showing up as a traditional shareholder. And these tools exist for one reason: flexibility. Derivatives, swaps, and structured instruments allow capital to express conviction while managing visibility, risk, and timing. This is not about hiding, it's about precision. Take total return swaps as an example. Through a swap, an investor can receive the economic benefits of owning a stock, price appreciation, and dividends without technically owning the shares. A bank holds the stock on its balance sheet, and the investor receives the return profile. To the public eye, the bank appears as the holder. The economic exposure sits elsewhere. This distinction matters because it means large positions can exist long before ownership ever appears in a filing, if it appears at all. Options add another layer. Long-dated calls, structured spreads, or custom OTC options can replicate upside exposure while limiting capital outlay and downside risk. These positions can be scaled, adjusted, or unwound far more efficiently than outright equity, especially during accumulation phases. They also allow exposure to be built without competing directly for visible shares in the market, reducing price impact during critical windows. Why does this matter? Because markets respond to signals. When ownership crosses certain thresholds, behavior changes, liquidity providers adjust, counterparties reassess risk, and prices begin to reflect not just fundamentals, but perception. Derivatives allow exposure to be established before those signals are triggered. They separate economic belief from public footprint. This separation is strategic. It allows capital to test a thesis, size into it gradually, hedge around it, and adapt as new information emerges. If conviction strengthens, exposure can be converted into ownership. If conditions change, exposure can be reduced without the friction and visibility of selling large blocks of stock. Flexibility is not optional at scale, it's survival. There's also a misconception that derivatives are speculative tools. In reality, they're risk management instruments first. They allow precise control over duration, volatility, and downside. Large institutions don't use them to gamble, they use them to shape exposure with intent. Every structure exists to answer a specific question: how much risk do we want, when do we want it, and how visible should it be? This is why headline ownership numbers often fail to tell the full story. A seemingly modest disclosed stake can mask far greater economic exposure. Conversely, a large reported holding may be heavily hedged, reducing real directional risk. Without understanding the derivatives layer, observers are guessing, and markets punish guesses. The modern market rewards those who understand structure. Ownership is just one expression of conviction. Exposure is the real signal. And the most effective participants are the ones who know when to be seen, when to be silent, and how to let economic reality work long before the paperwork ever catches up. Scale changes everything. What works for a small order fails catastrophically when you're moving serious size. At that level, execution is no longer a mechanical task. It's a strategic discipline. Every trade sends a signal, and in competitive markets, signals are exploited. The goal isn't just to buy, it's to buy well, without advertising intent or inviting interference. Large positions are never executed in a single stroke. They're engineered over time through algorithmic strategies designed to blend into the natural rhythm of the market. Time, weighted and volume, weighted execution models break a large objective into thousands of small decisions, each calibrated to current liquidity conditions. The trade doesn't dominate the market. It becomes part of it. When liquidity rises, participation increases. When it thins, the system steps back. Patience is embedded in the code. Routing matters just as much as timing. Orders are deliberately fragmented across exchanges, alternative venues, and private liquidity pools. No single venue sees the full picture. No broker understands the full intent. This dispersion isn't paranoia, it's protection. Concentrated flow invites predatory behavior. Distributed flow denies it. The market sees noise, not conviction. Execution also adapts. Algorithms aren't rigid scripts, they're feedback systems. They respond to spread changes, order book depth, volatility spikes, and abnormal volume patterns. If price begins to move too quickly, the system slows or pauses. If hidden liquidity appears, it accelerates. The objective is always the same: minimize market impact while maximizing fill quality. Cost is measured not just in price, but in information leakage. This is where discipline separates professionals from spectators. Emotional traders chase urgency. Institutional traders engineer inevitability. They accept that the best trade is often the one that takes longer than planned. Speed is only valuable when it's invisible. Execution strategy also includes knowing when not to trade. Sometimes the optimal move is to wait for a macro event to pass, for volatility to compress, or for liquidity to return. Capital that can wait holds an advantage over capital that must act. Time, when used deliberately, becomes leverage. Critically, execution doesn't end when the shares are acquired. Ongoing monitoring ensures the position remains aligned with evolving market conditions. Exposure may be adjusted, hedges layered in, or participation reduced once size is achieved. Accumulation is not a finish line, it's a phase in a continuous process. Most market participants never see this layer. They watch price and volume and assume they understand what's happening. They don't. What they're observing is the surface. Beneath it lies a complex interaction of algorithms, liquidity providers, and risk controls, all designed to solve one problem: how to move large amounts of capital without moving the market itself. In modern markets, execution is alpha. It doesn't show up in a pitch deck or a headline, but over time, it separates average outcomes from exceptional ones. Those who master it don't need the market's attention. They need only its cooperation. Secrecy in markets is often misunderstood. It's not about deception, and it's certainly not about avoiding scrutiny. It's about responsibility. When you operate at scale, every action has consequences, not just for your portfolio, but for liquidity, price discovery, and market stability. Discipline in how and when you reveal intent is part of managing that responsibility. The market rewards clarity of thinking, not clarity of signaling. Broadcasting a large position too early invites speculation, copycat behavior, and volatility that has nothing to do with fundamentals. That noise doesn't help investors, and it doesn't help companies. Thoughtful participants allow the market to discover value gradually on its own terms, rather than forcing recognition through aggressive visibility. Risk management sits at the center of this approach. Large positions are never binary bets. They're built with contingencies, hedges, optionality, and exit paths that can be activated without disruption. Maintaining discretion ensures those safeguards remain effective. Once intent becomes obvious, flexibility disappears. Counterparties adjust, liquidity thins, costs rise. Silence preserves choice. There's also a misconception that conviction requires public validation. It doesn't. True conviction is quiet. It's rooted in research, stress testing, and a willingness to be patient while others react emotionally to headlines. Markets are full of participants who mistake motion for progress. Professional capital understands that restraint is often the most powerful move available. This philosophy extends beyond entry. Even after a position is established, exposure is actively managed. Size is adjusted as information evolves. Correlations shift. Macroeconomic conditions change. A position that made sense at one moment may require refinement at the next. Discretion allows those adjustments to happen smoothly without telegraphing stress or inviting opportunistic pressure. Transparency, when it arrives, should be the byproduct of process, not a marketing event. Filings, disclosures, and public acknowledgement are compliance milestones, not strategic announcements. They occur after the work is done, not while it's underway. Those who wait for confirmation often arrive just as the opportunity is maturing. The broader lesson is this: markets don't reward those who seek attention. They reward those who manage complexity well. Every advantage in modern investing is incremental. A basis point saved here, a signal avoided there. Over time, those increments compound into meaningful performance. Ultimately, the ability to move quietly isn't about dominance. It's about stewardship. Capital deployed with discipline strengthens markets rather than distorting them. It allows price discovery to function, liquidity to remain deep, and risk to be absorbed efficiently. In the long run, the most successful participants are rarely the loudest. They're the ones who understand that in a system driven by information, sometimes the most valuable thing you can control is when you choose to speak and when you don't. So the next time you see a headline announcing that a massive position has been revealed, pause. Don't ask what was bought. Ask when it was really built. Because by the time the world is allowed to see it, the most important work is already over. The risk has been managed. The cost has been controlled. The advantage has been captured. What looks like a beginning to the public is usually the final disclosure of a strategy that started long before anyone was watching. Remember this: markets don't reward excitement. They reward preparation. The loudest moves are rarely the smartest ones. Real conviction doesn't arrive with noise. It arrives quietly, patiently, almost invisibly. What you've learned today isn't a secret playbook. It's something more powerful than that, a shift in perspective. You now know that price is a consequence, not a signal. That volume is often camouflage. That disclosures tell you where someone has been, not where they're going. And most importantly, you now understand this: the difference between reacting and leading is measured in understanding, not speed. While others chase confirmation, professionals build positions. While others wait for headlines, professionals manage execution. While others seek validation, professionals protect process. The market will always have two groups of participants: those who watch the surface and those who operate underneath it. One reacts, the other designs outcomes. From this point forward, every chart you see should raise a new question. Every filing should trigger a deeper thought. Every sudden discovery should make you wonder how long the real story had been unfolding before you were invited to see it. This is how advantage is built: quietly, patiently, relentlessly. And once you start thinking this way, the market stops feeling random. It starts feeling engineered, structured, intentional. Stay curious. Stay disciplined. And remember, the most powerful moves in this market are never announced in real time. They're revealed only after they've already worked.